Hey everyone, John here. Today we're going to be looking into the conflict between shareholder value and corporate responsibility. We'll also be looking at how we can reconcile these things. This is a response to an article by Business Day columnist John McDuling.
It has been described as the dumbest idea in the world. It might just be the worst idea in finance, and it looks like it's finally falling out of favour.
Intriguing. What could this idea be? Who described it this way, and have they been horribly misquoted for political purposes? Let's find out.
A backlash is brewing against the theory that has underpinned the past 3 decades of capitalism, the concept of shareholder value. The idea that companies should put returns for their shareholders, profits, dividends, and stock price gains, over and above everything else is being questioned from surprising quarters. Consider comments Larry Fink, the CEO of BlackRock, the world's biggest fund manager, which oversees investments worth $6 trillion, made this week. Society is demanding that companies, both public and private, serve a social purpose, Fink wrote in a letter to more than 1,000 CEOs. Earlier this month, 2 Big Apple shareholders united to publicly chastise the world's most valuable and profitable company for damage its key products, the iPhone, is doing to children's minds. And in November, the $1 trillion Norwegian sovereign wealth fund signalled it could stop investing in oil and gas producers, ironic since the fund was established from oil and gas royalties, having ditched tobacco stocks and some arms dealers. In any case, some of the world's most powerful investors are becoming less obsessed with immediate returns, and they want executives to think the same way.
So from the perspective of the general public, a world of corporations acting responsibly is obviously better than one in which they run rampant land waste to the countryside. That is definitely not something that we want, but there's other issues to be weighed up against as well. Every example that McDuling just gave of what he calls powerful investors demanding responsibility over profits were heads of managed funds. Now, while it's true that these people are extremely powerful due to large amounts of money that they manage, none of these people are investing their own money. They all manage other people's money. And that makes a big difference to how they are likely to prioritize company performance, as it is not their retirement savings that are being handicapped, but those of your average mums and dads. The investment managers need to remember that their power is borrowed from the collective savings of ordinary people, and that they have a duty to provide people with financial security in retirement. That's its own kind of corporate responsibility, and the primary one that retirement funds should be focused on. There are managed funds that advertise themselves to investors as responsible funds, and these should absolutely place priority on the allocation of investments according to conscience. People can choose to invest in these types of funds and receive returns accordingly, but we need to remember that it is their money and therefore their choice. Managed funds exist to serve their customers, not the other way around, as is the case with any company, but we will circle back to that later.
Maximising shareholder value seems like an unremarkable concept to us now. Companies aren't charities. Isn't it the whole point of them to make profits? Yet in the 1970s, when the idea was championed by the economist Milton Friedman in the pages of the New York Times, it was considered radical. The 1960s and 70s weren't entirely rosy. It was a lost era for US stocks when American companies were bloated and inefficient and lost ground to overseas rivals. But there is a general acceptance that in those days companies recognized that they had a responsibility to groups beyond their owners, to their employees, to their own customers, and to the broader society. It wasn't really until the 1980s, the era of Gordon Gekko and his greed is good maxim, that focusing on shareholder returns became the mainstream business thinking.
Well, first of all, the fact that companies in the 1970s were so bloated should explain to you why Friedman was making this argument, which, by the way, was a drum that he'd been beating since the 1950s. Similarly, the view that corporate greed peaked in the 1980s is a much oversimplified view of history. Let's remember that Gordon Gekko is a fictional character. To refute this, I need only provide the example of the British East India Company. This is the only time in history so far that a corporation has officially ruled over an entire country. Do we think that they felt they had much of a sense of corporate responsibility to the Indian people? Well, of course not. They were exploiting them and shaking them for everything that they could get. In the British Raj, the executives of the East India Company were treated like kings because in a very real sense they were kings. So no, the time before the 1980s was not some utopia of corporate responsibility, nor are inefficient business practices a good thing for society.
It was Jack Welch, the former CEO of General Electric, who famously described shareholder value as the dumbest idea in the world, despite adhering to the principle during his 20-year run at the helm of the industrial giant. Critics of shareholder value theory say it has driven an explosion in executive compensation relative to worker pay, and is one of the reasons why inequality in the US is, on some measures, back at Depression-era levels. By forcing CEOs to obsess over each quarterly result, it has also led to short-termism, which has stifled investment and hurt companies' long-term performance, which undermines the whole point of the exercise.
So this quote from Welch comes from an interview that he did for the Financial Times back in 2009. So what did the guy actually say?
On the face of it, shareholder value is the dumbest idea in the world. Shareholder value is a result, not a strategy. Your main constituencies are your employees, your customers, and your products.
Now, while he did indeed say that shareholder value is the dumbest idea in the world, the charitable way of reading this is that he was speaking incautiously. He isn't suggesting that shareholder value shouldn't be the goal of a company. He's saying it shouldn't be the strategy used for attaining that goal. A little history here. Welch became known as the father of the shareholder value movement after a speech he did back in 1981. He went on to produce enormous returns for the shareholders of GE. After this point, many companies adopted what can be considered to be a mangled abomination of this theory, the view that companies should be focused on share price and short-term profits. Where this really goes wrong is when this fed into the compensation scheme for executives. So an executive receives a massive bonus for short-term movements in share price and meeting profits on a short-term basis. Often these incentives are wrong, and this is a horrible strategy for the company in the long term. Indeed, Welch followed up his comments in a CNBC interview a week after his interview with the Financial Times.
Look, it's always the same. You've got to eat while you dream. You've got to deliver on short-range commitments while you deliver on a long-range strategy and vision and implement it. The success of doing both. Walking and chewing gum, if you will. Getting it done in the short range and delivering a long-term plan and executing on that. That's what it's all about. That's what management is, making choices. Any jerk can have short-term earnings. You squeeze, and the company sinks 5 years later. Any jerk can sit there and say, hey, come back in 5 years. I'm doing my long-range thinking. Get out of here. Management is all about managing the short term while developing the plans for the long term.
But the point of Welch's comments gets ignored. A high-profile advocate of shareholder value said that shareholder value is the dumbest idea in the world, and many people opposed to capitalism look at this comment and run with it. So what's the issue here? Well, let's break it down. Where things went wrong is in confusing shareholder value with share price. These things are not the same. Back in 1934, economist Benjamin Graham published a book coining the term intrinsic value. This is the idea that a stock can have a value that is independent of what the market will pay for it on any given day. For example, if you go to a supermarket and buy an apple for various reasons, the cost of that apple will be different for what it was for the same apple 6 months ago. Has the value of the apple changed to you, the consumer? No, you eat it and you get the same benefit from the apple regardless of the price that you paid for it. You might be willing to pay more or less for it for various reasons. I mean, is it in season? Can you buy it cheaper elsewhere? And so on. But this is independent of the actual value of that apple. The price is different, but the intrinsic value is the same. Focusing executives on share price is definitely a dumb idea, and this isn't helped by the focus of many investors on short-termism. There are legions of day traders who treat the stock market like a casino and simply don't care about the company that they've put their money into. To them, it's just a piece of paper. It's truly frightening just how much of this money is invested by people who have no clue in the businesses they're bought into. And this also applies to many investment professionals. The intense focus of these gamblers on daily price movements also has an influence on other investors, skewing everyone towards short-term thinking. The dual problems of short-term thinking and confusing share value with share price also extends to people who should know better, for example, the financial press.
Chad Slater, Chief Investment Officer at Sydney-based investment company Morphic Asset Management, agrees the pendulum has now swung too far towards shareholder value. The problem is, experiments with alternative approaches to it have been mixed. Etsy, a US-based online marketplace for artisanal products, listed on the New York Stock Exchange in 2015 as a public benefit corporation, a rarely used structure allowing it to de-emphasize shareholder returns in favor of social and environmental goals. Last November, Etsy's new CEO decided to abandon the status after cutting costs and laying off workers. The reason he did this? Pressure from shareholders due to poor returns. On the other hand, a company like Amazon places little explicit emphasis on its shareholders and professes to be much more focused on customers. Amazon is no saint. It's been criticised for grueling conditions in its warehouses, for its record on paying taxes, and for destroying jobs in the retail sector. Yet from an investment perspective, customer-first approach is difficult to fault. Amazon shares have performed absurdly well over the past 2 decades, rising more than 50,000%.
I think these examples show very well the failure of understanding of people around this issue. The case of Etsy and Amazon are obviously in no way comparable. If you look at the Amazon example, depending on the type of business, a strategy of focusing on customers will often help you achieve a goal of increased shareholder value. The strategy and goal are not in conflict, and there is no pendulum to swing. The Etsy example is a completely different story. If the author's characterization of this company is correct, it is expressly stating that profit isn't the primary goal of the company. If the company was upfront about this to its shareholders, then they have no reason to complain when the company has poor returns, since they invested with full knowledge that this would be the outcome. The trade-off of this is that in exchange for lower returns, they have a kind of moral reward for helping out the community, similar to donating to a charity. But here's the thing, this emotional and social reward can also be considered to be shareholder value. Provided the company clearly informs its potential investors that profit is not the goal, then this is completely acceptable.
Morphic Slater says companies should still focus on shareholder value, but to deliver sustainable, long-term returns, they need to be good corporate citizens. So the strongest argument against shareholder value theory might not even be moral. The narrow pursuit of profit above all else is simply bad for business.
No, there is no moral argument against shareholder value. We need to remember that the shareholders own the company, and it is immoral for the company executives to act against their interests. The goal of the company must be clearly communicated to shareholders who can freely choose to invest or not based on whether or not these goals match their own. If this is the case, the goal can be considered to be providing them with value, and that value need not be a financial one. Regardless of this, McDuling is correct in his statement that companies should not have a narrow profit focus. We as a society should want them to be good corporate citizens. So how do we make this happen? Well, we can't rely on activist investors to keep our companies socially responsible. These people will always, on average, be a declining capital force, since their investments will be handicapped and as such will tend to grow at a lower rate than those who invest solely for profit. Therefore, the financial power of for-profit investors will always beat activist investors over time, and the latter will become an endangered species because of this. So what's the answer? Companies must keep a good corporate image and a good relationship with their customers, or else risk lower sales and financial loss. So for a company, the path to financial success is through their customers, and therefore the task of keeping companies on the straight and narrow falls to them. When customers vote with their wallets, we expect companies to act in their own rational self-interest, and if they fail to do this, they will not last long on the free market. Therefore, it falls upon activists to inform the public of egregious corporate behavior, to create public awareness, and to arrange boycotts. If enough of the public won't stand for sweatshop labor or environmental pollution, then companies that employ these practices will be forced to change or die. If, on the other hand, not enough people care about these issues, then again, it falls on activists to change their minds. That being said, the activists need to focus their attention on the real harms caused by companies. There is a problem that those motivated enough to become activists also tend to be ideologically motivated, and this can cause them to advocate for changes that are either not helpful or harmful. They are also quite willing to mislead the public to achieve their own agendas. An example of this being the recent H&M scandal. The company in this case had produced a line of jungle-themed children's clothing, and the catalogue showed a black child wearing a hoodie with the slogan, "Coolest monkey in the jungle." This was seen by many as a racial slur, and on being informed of this, the company immediately apologized and withdrew the hoodie from sale. But this wasn't good enough for the activists, and there were many protests outside H&M stores, the most intense of these being in South Africa, where several H&M stores were trashed. While it's completely understandable that South Africans would be especially sensitive to racism due to apartheid, despite this was obviously an unintentional mistake by the company, and once they realized the mistake and apologized for the incident, this should have been the end of the issue. I mean, compare this to Nike and their prior use of child labor, or Apple outsourcing manufacturing to Chinese sweatshops where employees were committing suicide so often they had to put a net around the building. These things are just simply not comparable to a company making an unintentional mistake. By trashing the South African stores, the activists have taught the company absolutely nothing, except that with property damage and increased security costs, it may no longer be profitable for H&M to trade in South Africa. If the company is forced to close in that country, then local employment opportunities will be lost, and South African consumers will no longer be able to buy H&M products. No one is helped by this. We know that investors can be harmed by their own short-term thinking and the influence that this has on executives. As such, they owe it to themselves to become a better class of investors. Likewise, the interests of the community are harmed by the narrow-minded views of activists and the influence that this also has on executives. As such, they owe it to the community to become a better class of activists. Corporations and executives are incentivized to cater to wants of investors, activists, and consumers. As such, considering that we are all of these things, it is beholden on us to understand our own interests and those of our community, and make sure that we only demand of companies those things which help us in the long term. It is only by improving ourselves that we improve these companies, and therefore the world. And if we do that, the interests of shareholders and the interests of the community will not be in conflict. Well, that's my opinion on this subject, guys. Interested to know what you think? Leave a comment in the comments section, like and subscribe. Thanks very much. Talk to you later.